Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your personal finance questions, and to that end, sometimes we ask you to write to us and tell us what you would like to know. And some of you have asked specifically about hybrid funds. How do you incorporate them into your portfolios, and what purpose do they serve? So today, we're going to talk about two subcategories of the hybrid mutual fund space, and those are balanced advantage funds, the largest subcategory, and aggressive hybrid funds. Now, to somebody that is completely unaware of this space, they're going to sound like complete Greek and Latin. You won't know what this is about. So that's what we're trying to fix today. Don't worry about it. Joining me in studio to tell you exactly what you need to know is Megha Malpani, who is the founder of Zvest Financial Services. Megha, thanks so much for taking the time.
Thank you so much, Alex, for having me here.
So let's start with the definitions. Before we get into the purpose of each of them, the Balanced Advantage Fund is also called the Dynamic Asset Allocation Fund. What is it all about?
So, Alex, I think, it's a very pertinent question today when the markets, are kind of playing around for a long time. And a lot of people are finding solace in the hybrid category. So there are many subcategories within hybrid funds, and the two most important categories definitely include balanced advantage funds and aggressive hybrid funds. Now, to answer your question, balanced advantage funds are funds which, as per SEBI regulations, can play around between 0% to 100% in equity allocation. Just to draw an analogy, I would say they are like the auto transmission in a car, where the car is actually trying to switch its gears depending on the speed. So here the fund manager would typically decide basis the market, which could be either a cyclical approach or it could be a counter-cyclical approach, as to how much equity he or she wants to run in the portfolio. Aggressive hybrid funds, on the other hand, necessarily have to have 65% in equity or equity-linked instruments, so as to ensure that they kind of fall in the equity tax bracket. Having said that, it is also important to understand that while they appear similar, the way both these funds are managed could be very different, and it is important for every investor to know where he or she is getting into.
And that is the purpose of this conversation. I'm glad that you've explained it with an analogy. You said this is like auto transmission, right? It's in a normal situation where you talk about asset allocation and you talk about portfolio building, an individual is supposed to have a certain equity component, a fixed income component, possibly even gold and silver, commodities, right?
Right.
And depending on how the fluctuation happens in the markets and where you think your portfolio should be, you rebalance.
Right.
This involves selling of equity and buying of fixed income, or vice versa, however you need to do it. In this case, because it's auto transmission, the fund manager is doing it for you. That's a simple way to explain it.
Right.
Now, what I want to understand is, how do fund managers interpret this differently? You've laid out the broad guardrails of what the Securities and Exchange Board of India has said in its regulations, but how does a fund manager in different mutual funds look at these two categories?
Right. So, most of the fund houses today follow proprietary models which run on multi-factor variate analysis to determine how much equity and debt to have. A point I would also like to mention, Alex, is that especially in the hybrid category, it is also important to evaluate the quality of debt in the mutual fund, because if it is compromised there, it can get you an alpha, but it will come with an added risk. And unlike equity, the loss on the credit side could be a permanent loss.
So let's simplify this a little bit, just to make sure that all of my viewers are understanding this. What you're saying is that in your balanced advantage fund, where you have the ability to go 0 to 100 in equity, usually people don't go to 100. Yeah. Usually it is what, 50-60% depending on the market, and the rest is filled up with fixed income, right, which is both government securities as well as corporate bonds. This is debt that is issued either by the government or by companies. And when it is issued by the companies, you have a situation where there is a credit risk involved, right? This is denoted by your rating that each company has, an issuer rating. And if you go down the list from AAA all the way down to triple B, you have triple B, which forms the base of that investment grade. I don't think anybody goes that far, though. Is that right?
They don't go, but there are funds which run only AAA rated papers. They do come down to double B sometimes. Also, it is important to understand the duration or the interest rate risk, especially in an environment where in the last 4 or 5 years we have had, first a hike in interest rates followed by, reduction that we are seeing right now. So I just thought it is important to understand that bit as well.
So both, yeah. So you could have duration as well as credit risk. Duration risk, of course, is when if you're investing in a bond and if it is a 10-year bond, for example, and the interest rates fall, then that's beneficial for you, correct?
Yes.
Because you bought a higher yielding paper. Anyway, without getting into too many of those specifics, let's talk about what the purpose of each is. We've defined how they work, kind of. We'll get into some schemes that you have focused on, but before that, the time frame. You look at equity and you say 5 years is ideal, 5 years and beyond. Does this fall less than 5 years, or is it also considered long term? Both of these.
Right. So it is important to understand, Alex, that ultimately it has equity as a part of the portfolio. And in my opinion and experience, I would suggest a balanced advantage fund is good for a 3 to 5 year kind of a view.
Right.
However, if you're kind of looking at an aggressive hybrid fund, I would suggest a time horizon of 5 years. The way I look at it is that over a 3 to 5 year period, in a balanced advantage fund, the returns get smoothened over the longer term. And because it necessarily has a 65% minimum threshold of equity to maintain in a static hybrid fund, I would say that a 5 year holding period would not completely eliminate the risk of principal, but it would be a sufficient guardrail to have.
Okay. In your experience broadly, what level of equity does a balanced advantage fund have? And of course, we'll get into how each of these strategies are maintained or done differently. And how does it relate to what your aggressive hybrid does? Because I've seen a lot of balanced advantage fund managers keep that 65% threshold maintained in equity for that equity taxation. They can use arbitrage plus equity if they want to reduce the risk in the portfolio.
Right. So in my experience, I have seen most of the fund houses run on an average 40 to 60% in a dynamic asset allocation fund. In times, of crisis like COVID, I remember a lot of fund houses went all the way up to 75 to 78% of equity, during that March 2020 period, which, kind of added sufficient alpha in the portfolio in hindsight. In the aggressive hybrid category, on an average, I have seen most fund houses maintain close to about 75% thereabouts in equity exposure.
Okay. So therefore, with that understanding, what is the return profile that an investor should expect when they're looking at these two categories? And we've already defined the timelines that they should have.
Right. So to my mind, both these categories are absolute return products. They are not relative return products.
Yeah.
I would say that in case of a balanced advantage fund, decent, reasonable return expectation should be in and around 10%. However, in an aggressive hybrid fund, you could target a 11% kind of a return. It is also important to understand that different fund houses run these funds very, very differently. We need to understand who's the ideal customer who comes into this. He's somebody who is conservative, right? Having said that, if, a fund house is taking extraordinarily high exposure to small caps in the portfolio, it may kind of get you higher returns, but it may not suit the requirements of the investor.
Very important.
Yes.
And so therefore, it brings me to the next question, which is, you said this is for a conservative investor. Even the aggressive hybrid is for a conservative investor?
Alex, I wouldn't want to look at it just from a conservative investor or an aggressive investor. I think hybrid as a category holds merit for every portfolio to have, because life is not lived in spreadsheets.
Sure.
We can kind of design that we may not have a liquidity requirement in the next 3 years or 5 years, but life doesn't play around like that. So these kind of funds give cushion to any portfolio wherein you are not disturbing your core portfolio in case there is an unforeseen liquidity that comes up.
Yes.
Yeah, so to my mind, I would not look at it from a conservative or an aggressive hybrid.
What I was getting at is that, of course, there is a case to be made for the inclusion of these schemes in multiple portfolios, but I'm saying the extent to which you would take exposure would depend on your risk profile, etc.
Absolutely.
So compared with a pure equity product, an aggressive hybrid product would be less risky, relatively speaking, and so therefore a conservative investor, somebody that does not want to take that element of risk but still wants an equity-like product that could cushion a fall, they can look at aggressive hybrid. That's what I'm trying to define the ambit of who should be looking at this very closely.
Yes, so somebody who doesn't want to take 100% equity funds, but is probably looking at a little more alpha compared to a pure play fixed income product, I think it is a good product for that investor. Also, I think it depends on some other factors, like when do you have the liquidity need? If you have a liquidity need in a 3 to 5 year kind of a horizon, I think then this product deserves a position in the portfolio. Then there are people like us, there are fund managers, there are the AMC teams wherein our incomes are largely related to the performance of the markets. There are doctors who sometimes do not have a fixed pay, in people who do not have a very consistent, steady monthly flows. I think for such profile of people, there is decent sense for these funds to have a little higher allocation.
Sure. Okay, let's get into the brass tacks, because as you've mentioned, proprietary ways of managing these schemes. Let's first talk about balanced advantage, and we can't go through the entire list, but then there must be some that have stood out to you and certain reasons why. Let's talk about 3 of them, if possible.
Sure. So I think in this space, the first fund that comes into my mind is definitely the ICICI Prudential Balanced Advantage Fund. I think they're the pioneers as far as this category is concerned, having the largest AUM as well. I think the biggest advantage ICICI has as a fund house has been their macro calls, and they kind of follow they kind of run this on a counter-cyclical manner, wherein they take care of valuations in terms of price to equity, price to book, etc. They have largely maintained large caps as far as the equity component of the fund is concerned, which again comes down to your previous question that it is reasonable for a conservative investor to have. And I think their debt calls have also done very well with no defaults, even during the tough times that we saw in 2018.
And how does that differentiate with the other 2?
Yeah. So the other fund that stands out in my mind in this space is definitely the SBI Balanced Advantage Fund, wherein they kind of run on factors like earnings, sentiments, which kind of helps understand the pulse of the traders and how the activity is happening on a daily basis as far as market volumes are concerned, and they focus on fundamentals as well. Another fund that stands out is the Edelweiss Balanced Advantage Fund, wherein they look at market trends, they define something called the trend health, and again they look at fundamentals as far as deciding how much equity and debt to have.
We'll have to run through the aggressive hybrid, but what 3 schemes stand out to you here?
Again, I think ICICI, Edelweiss and TSP, I think the principles of credit and large cap that I spoke about ICICI stand true even as far as their aggressive hybrid fund is concerned, because largely the teams would remain the same. Same is true as far as SBI is concerned. I think they follow, they take a lot of aid and assistance of quants to understand the pulse of the market as far as sentiments is concerned. I think DSP in the hybrid category is a relatively newer kid on the block because the fund has had quite a turnaround, and the way I see it is that they are focusing a lot on the risk management that has led to the fund doing reasonably well in recent times. Also, I believe that they take a lot of bottom-up stock selection, which also helps them manage the active share of the portfolio well, which has kind of guided the performance in recent times.
Great. Megha, I think this has been a very insightful conversation. Thank you so much for making the time and for coming to the studio. Pleasure having you.
Same here. Thank you. Pleasure's mine.
All right, so that should give you a sense of how to approach this category. And of course, it can be a little daunting looking at so many schemes, but at least Megha has helped you narrow the list a little bit and understand where it fits in your portfolio.